Hello everyone, this is Ayush and I am a member of Financial Industry Group. With me there is Gaganpreet, Khushali, Mayank and Rohan, and we are here to present our capstone project, that is credit risk analysis. So coming to the financial industry part, the financial service sectors supply financial services to people and corporations. Banks, investment houses, lenders, finance companies, real estate agents, and insurance companies are among the financial firms that make up this sector of the economy. The financial services business is the most important sector of the economy, with earnings and equity market capitalization dominating the world. Analytics is used in various domains of finance industry, which includes new and old fields such as fraud detection, customer service, and risk analysis. Talking about the main objective, our main objective is to determine the extent of risk bear by bank while offering credit to customers. So what is credit? Credit refers to the capacity to borrow money or get goods or services on the condition that one would repay the debt later. In order to make purchases and other financial decisions, society is growing increasingly reliant on credit. So basically our project aim is proposing the best model that can help banks decide whether a person should be given credit or not, for which we have used a data set obtained from German banks.
Hello everyone, I'm Khushali Palikar and I'm going to continue the presentation talking about literature review. The first paper I'm going to talk about is Financial Credit Risk Assessment. In this article, traditional statistical models and the state of the art intelligent approaches for monetary crisis forecasting has been studied with an emphasis on recent accomplishments as a promising trend in this area. The next paper I'm going to talk about is a multidimensional analysis of data quality for credit risk management, new insights and challenges. And the challenge stated in this paper is that in today's environment, increased firms are having problems with data complexity, and to address this issue, the author proposes a comprehensive program that involves understanding the various dimensions of data quality in credit risk databases, analyzing the concerns, and suggesting credit risk assessments improvement solutions. The next paper I'm going to talk about is Credit Risk Management through Big Data Analytics. This paper talks about various difficulties that the financial institutions face in assessing a customer's creditworthiness. There are a lot of financial institutions that hold an exceptionally large amount of data about the customers' credit scores, spending patterns. However, making use of such a large amount of data to assess the creditworthiness is a challenging task. This paper focuses on how big data analytics can be used to solve this issue. Now I'm going to talk about the article Credit Risk Analysis and Prediction Modeling of Banks using R. The paper focuses on developing a system that can help the banks better assess a customer. For this, a dataset available in the UCL repository is used. Data mining is an effective method of data analysis. It is used to extract useful information. The next article I am going to talk about is a comparative study on data mining algorithms for individual credit risk evaluation. Individual credit risk evaluation using data mining is the problem addressed in this research using two credit data risk and sets. This study examines the effectiveness of four data mining algorithms, that is logistic regression, decision tree, support vector machine and neural network. Its main purpose is to extract non-obvious but valuable information from large-scale data set for decision making, examining the characteristic of a newly presented product and assigning its one or two predetermined classes, that is good customer or a bad customer. Pre-classified examples must be used to train a data mining model for classification. The goal is to create a model that can accurately categorize incoming data based on the outcomes and interrelationships of many discrete variables like credit history, saving account, property, and so on in the training set. Two experimental datasets provided by UCI KDD archive are used in this article, that is German commercial personal credit dataset and the Australian personal credit dataset. The performance is assessed by looking at the classification accuracy, precision, and type 1 error rate. In general, the computer simulation suggests that the LR and SVM algorithms have the best classification effectiveness. In this slide, I am going to talk about the industry overview. The financial services sector is the engine that propels a country's economy forward. It allows capital and liquidity to flow freely in the market. The economy expands when the sector is robust and the businesses in this area are better prepared to manage risk. The financial services sector's strength is also critical to a country's population and prosperity. Consumers earn more when the sector and economy are doing well. This increases their purchasing power and confidence. They turn to the financial services sector for credit when they need it for the significant purchases. The major sectors in this financial industry are the banking services, and the financial services business is built on the foundation of banking. Direct saving and lending are its main concerns, but the financial services industry includes investments, insurance, risk transfer, and other financial operations. Large commercial banks, community banks, credit unions, and other institutions provide banking services. The next sector is insurance services. It is a key subsector of the financial services, and it can be used to protect against death or injury, that is life insurance, disability income insurance, health insurance, property loss or damage. The next important sector is the tax and accounting services. Accountant and tax preparation services, currency exchange and wire transfer services, and credit card machine services and network are all part of this industry. It also covers debt settlement services and worldwide payments processors like Visa and MasterCard, as well as stock, derivatives, and commodity exchanges.
Hello everyone, this is Mayank Sharma and I'll be discussing data section and methodology. The goal of the research is to decide the extent of risk that a bank can bear before lending credit loans to the customers in Germany. The datasets used is a German-based dataset and is obtained from Kaggle, which is considered a reliable source for exploring datasets. The original dataset consisted of 1,000 entries along with 20 attributes, out of which selective attributes have been kept that majorly contributes to the model's aim. The selected attributes are age, sex, job, housing, checking account, credit amount, duration, purpose for which the loan was applied, such as car, furniture, TV, domestic appliances, repairs, education, business, etc. And it is clearly standing for that the dataset consists of both numerical and textual values. It is hence cross-sectional. Also, the data frequency is monthly. Factors like job, housing, credit history would play a dominant role in achieving the goal. For analysis, we used Python, which is an open source programming language. Some of the libraries which we used are Pandas for data manipulation, Matplot, which is for visualization, and Seaborn, which is for statistical computing. Thank you.
Hello, my name is Rohan and I'll be discussing the analysis and its interpretation. We used Python and its various libraries for this process. So here, we have a bar graph and a box plot that depicts the age and sex distribution and how they are related to the risk. From these graphs, we can say that age does not affect the risk rating much and males take more count of credit from the bank compared to women. We also observe that males have a lower percentage of bad rating compared to women. In this image, the graphs depict the credit amount and duration distribution and how both of these are related to the risk factor. The graph tells us that higher credit amount and longer durations would give the banks a higher magnitude of risk. The following bar graph gives us a visual representation of job distribution with risk and housing distribution with risk. Here, we see that people who own a house means that they have less risk and provide a good rating to the bank. Most of the people in the records have job skill level 2, but that does not seem to bother the risk rating much. Now, moving to the savings account and checking accounts, we see how they are related to the risk factor. Those people with higher saving account balance possess less risk to the bank, but most people in the records have little savings. Moreover, about half of the people who have little checking account balance are considered to be bad rating in risk. Also, 20% of the people who have moderate checking account balance are also considered as bad rating. Using the Seaborn library in Python, we also developed a Pearson correlations heat map that show how an attribute is related to the other. Having a positive and higher value means it is positively related, and a lower value means it is negatively related. We can see that credit amount is highly and positively related to the duration for which the money is borrowed. Finally, to check which classifier would work best with a prediction model, we test our dataset with various classifiers such as support vector classifier, decision tree, random forest classifier, and Gaussian naive Bayes. We observe that random forest generates the best training and testing scores and thus proves to be the most effective. We also generate a feature importance table that shows which attributes are important and which are the least important. The attributes in blue circle have a higher importance value and the ones in the red have low importance value.
From the analysis and the various visual representations that we made, we can conclude that factors such as credit amount, age of the borrower, and the length for which the money is borrowed held higher significance than the other factors. The factors such as the job profile of the candidate, type of housing, and the gender are comparatively less important factors. The banks can implement a prediction modeling using the random forest classifier, which showed 84% accuracy on our dataset and is efficient and faster compared to other classifiers. It consistently gave a good result while training and testing the data. Coming down to the recommendation sections, there are few points that I like to discuss. The first and foremost thing is that the banks must analyze a borrower's capital level when determining creditworthiness. For instance, a borrower with a lot of capital is preferred to remain in good books of banks, since if the borrower's own money is involved, it gives them a sense of ownership and perhaps provide them an added incentive not to default on the loan. Secondly, creating a credit policy and keeping track of customers' trade references. For putting down a formal credit policy in writing shows customers that you're serious about your company's finances, and it also gives you legal leverage if you ever need to sue a customer for non-payment. We can also ask the references about the customer's payment practices, like did they pay their full amounts due on time every time? If not, uh, we need to carry out further uh, assessment on that particular customer. The duration of the loan is better kept shorter. For if the time period of the loan will be short, the customer is more likely to be able to pay back the loan in near future.